No questions? Okay. So let's review what we've covered so far. Here's a question for you. What is merchandising? Merchandising is another word for what?
Retail.
Retail, exactly. Okay. So let's cover some of the key points. Kimberly, make sure you put your name on the list over there. All right. So we talked about how service companies don't sell a product, right? So their operating cycle is pretty streamlined because they don't have to worry about physical goods. However, merchandisers, they buy inventory and then they sell it, right? So a merchandiser, or sometimes retailer, sometimes reseller, okay, those are all words for the same thing. They are both a purchaser and a seller, right? And that's why in this chapter, you have to really pay attention to, in this case, is the company buying or is it selling, right? Because it makes a difference in how you journalize the transaction. So we looked at the income statements, how for merchandising companies, they have to keep track of the costs of the goods that they sold, right? And we looked at the journal entries. Okay, we learned about the difference between gross and net when it comes to purchases. Start with your gross purchases. Take out any discounts you received on those purchases. And those purchase discounts were because of what? What causes the discount in that case?
If they pay in time.
They paid within the discount window, right? So they got a discount. You also take out any returns. Somebody tell me, what is a return? Okay, you return the product and you get a refund, right? You get a complete refund for what you returned. And how does that differ from an allowance?
You keep the thing, but they just make you pay less.
Okay, with an allowance, you don't return anything, but the amount that you owe goes down, or if you already paid, you get some money back, right? So once you subtract the discounts, returns, and allowances from gross purchases, you get your net purchase. How does that formula compare to the formula we use to get from gross sales down to net sales? Is there any difference? Really the same, right? So companies keep track of the total amount that they sold. That would be their gross sales. They subtract any sales discounts they gave to their customers, any sales returns that they accepted, and any sales allowances to get to net sales, right? So the formula is exactly the same. All right, we're not going to go through all the journal entries. We have enough of those in this chapter. I will remind you, not what I thought it was, okay. Oh, there we go. That's the formula I was just talking about. Looks basically the same as for purchases, right? Okay, these are the steps involved when you record the sale of merchandise using the perpetual inventory method. And perpetual means what? What's perpetual? Always, okay. And it's called that because you have to keep track of the cost of your inventory always. Every time you make a sale, you figure out what was the cost of that sale. And again, that is the more common method, and that is the method we'll mostly be using in this chapter. So, if you need to record a sale, you have to remember the revenue recognition principle. You record that sale because you provided the product or service, right? Regardless of whether or not the customer is paid. And then you also record the cost of goods sold. So whatever was the cost of that merchandise that you just sold, you record it as cost of goods sold, which is an expense. And you also reduce your merchandise inventory by that amount so that you know how much inventory you still have left. Again, the cost of the items that we purchase as a merchandiser include not only the cost of the item, but also any shipping costs, taxes, insurance, stocking fees, and related overhead. Okay. For the most part, we don't have to do all those calculations in this chapter. They keep it kind of simple for us. But just keep that in mind that it's not just the cost of the item, it's the total cost that goes into cost of goods sold. So this is what your basic sale looks like in the perpetual inventory method. You have to record both the sale and then either cash or accounts receivable, but also the cost of the goods, and you have to reduce your merchandise inventory. So when you make a sale in the perpetual inventory method, there are 4 accounts involved in that one transaction. Okay, which means if you accept a return, is this a return? I think it is. Yeah, it must be. So if you accept a return, it's the opposite of the sale, right? Because now you got the merchandise back and you have to give the customer their money back, right? Or reduce their account receivable. Oh, no, that is a sale, excuse me. Here's the return. Okay. So a sale looks like that. Notice here we have a debit to accounts receivable, a credit to sales, and that gets reversed. When the customer returns the item, we have a credit to accounts receivable because the customer no longer owes that money. And we debit not sales, but sales returns and allowances. The reason we use that sales returns and allowances account is because the original sale gets recorded as part of our gross sales. And then to get to net sales, we subtract sales discounts, sales returns, and sales allowances, right? So that way we know how much we sold, but we also know how much we got back because the customers weren't happy with it. And then with the original sale, remember we debited cost of goods sold and credited merchandise inventory. When the item is returned, we do the opposite. Because now our inventory goes up and our costs go down. Did you write your name on the list?
Yeah.
Okay, just want to make sure. So any questions so far? Okay, what else do I want to point out here? So with the periodic inventory system, when do you figure out your cost of goods sold? At the end of the period. And a period could be a month, quarter, a year. It's up to the company how often it wants to do that. Now, that means that if you use the periodic inventory method, you don't know what your cost of goods sold is, and you don't know what your remaining inventory is until you count it. And so you actually go and count up your inventory and do your calculations and figure out what is the cost of goods sold and what is our remaining inventory. So with the perpetual method, you're doing that with every sale, right? So you're always keeping track. So with the perpetual inventory method, is there a reason to count your inventory? Or can you just trust what your accounting records show? You need to do a count, right? Because there might be inventory that got lost, got stolen, or whatever. So even with the perpetual method, occasionally you would be doing a physical count to compare. Okay, and then I'm not going to go through these. This compares some of the differences in how you journalize, depending on which method you're using. But I think it's easier to use those charts that I showed you. You can refer to these if that's helpful, but I'm not going to spend time on it right now. So if you count up your inventory and you find that it's different from what your accounting records show, then you need to make an adjustment. So if you find you have less inventory than you thought, you need to credit your inventory. We know inventory is an asset, right? So to bring it down in our accounting records, we need to credit it. But that means your expense has gone up because the expense of that inventory becomes part of your cost of goods sold. So now you have to debit cost of goods sold for the same amount. And if when you count your inventory, you find that the opposite is true, you've got more inventory than you thought you had, then what would you do? The opposite, exactly. In that case, we would debit merchandise inventory because it's going up and credit our cost of goods sold because it's going down. Very good. All right. Now, in the periodic method, once you count up and figure out how much inventory you have, you can calculate your cost of goods sold. So here's the formula for doing that. Your beginning inventory plus the net amount that you purchased minus your ending inventory tells you the cost of what you sold. And how do you get your net purchases? Well, we got the formula for that too. Gross purchases minus discounts, returns, and allowances. Okay, so that will be useful. I think we did an exercise like that, didn't we? Did we? Okay. Right. So if you have another problem regarding that, then that'll be useful. I'm not going to review that either. It's too much information, right? We can keep this short and sweet since it's just a review. Oh, I think this was, let me see how far we are here. Okay, we got a little bit past this. So this was an example. Again, we don't have to go through it. Yeah, I think we can. Okay, so here was one of those charts. There are 4 of them. This one is This one is for perpetual inventory and for purchases. So if you're trying to figure out what account to debit and what account to credit, and it's perpetual inventory and it's related to a purchase, then you can use this chart and just find what's the right section, and there it tells you what to debit, what to credit. So we've got another one of these for perpetual sales. And then we've got one for periodic purchases and one for periodic sales. So I think that's the easiest way when you're not sure to look it up and see what to debit, what to credit. All right, we did that, we did that. That was as far as we got. So we are going to start here. Right? Any questions out there? So here we have an example again with a computer hardware company. And let's see, they have a price of $1,200 for a package of computer hardware. So we see the entire package here is $1,200. And the cost to the company for that package is $620. So they charge $1,200 to their customer. They pay $620 to their supplier. And the difference is their gross profit. We see the individual items, their prices, and their costs. Okay? So that is the information that these following journal entries will be based on. Let's see. Okay, so we're still using perpetual. Here the company sells 10 packages. So remember the price was $1,200, the cost was $620, right? So 10 times 1,200 is $12,000 of sales. We got paid cash. And then 10 times 620 means their cost of goods sold is $6,200. Merchandise inventory goes down by $6,200. Okay, that's the journal entry for their sale. They sell some computers. You notice this Journal entry looks pretty much the same in terms of the account names. Did the customer pay for the computer? No, and we know that because it says accounts receivable. Is there an option for this customer who bought the computers to get a discount if they pay early? No, there isn't, right? Because we see it says net 15, the terms are net 15. If that's all the terms say, net 15, that means the total amount of the invoice, the net amount is due within 15 days. There's nothing there about any option for discount. All right, so the customer makes their payment, they pay off the full amount, and the account receivable goes away. Then a customer buys 56 tablets on credit. Okay, so we see transaction for that. In this case, we do have credit terms. How would we read that? Would you say? That's exactly right. 210 net 30. You get a 2% discount if they pay within 10 days. The net amount is due in 30. Okay. The customer pays. Looks like the customer got a discount, right? Let's check the dates. Purchase was August 1st. Since they have 10 days, that gives them until the 11th. They did pay by the 11th. So they got a discount. Now, it was a 2% discount, right? So the way this was calculated, the total amount that the customer owed gets wiped off of their account receivable. Then we multiply that by 2% to get the amount of the discount. And the difference is what they pay. Do our debits equal our credits in this transaction? Yes. They always have to equal, right? Okay, and notice that as the seller, when we journalize this transaction and we gave the discount, it is a sales discount. If we were the buyer getting the discount, it would either say purchase discounts if we're using the periodic method, or what would it say if we were using the perpetual method and we were the buyer getting a discount? Yeah, let's say merchandise inventory. Okay. Excuse me, it doesn't say discount. It says merchandise inventory because it's reducing the cost of our inventory, and just because that's how you do it. Okay. All right. So they make a payment. I don't think there's anything interesting really to say there. Well, actually, let's see. Oh yeah, in this case, this would be where they didn't pay within that discount window, so they had to pay the full amount. Okay, then they make another sale. The customer paid cash. There are no credit terms when the customer pays cash, right? Because it wasn't a credit sale, it was a cash sale. Okay, then the customer finds some of the phones are the wrong color and they return them, okay? So now notice the transaction for the return is the opposite of the original purchase. And because the customer paid cash, we have to give them cash back. If it were an account receivable and the customer hadn't paid yet, we would just reduce their account receivable. But since they paid, we have to refund them. All right, what else? 20 more phones are slightly damaged, okay? So we give them an allowance in this case. Notice the same account is being used. Sales, returns, and allowances was used for the return. It is also used for the allowance. That's nice. One account, right, that we can use in both cases. And notice that because the customer had paid us cash, we gave them money back. But what's different between this journal entry and the return? There's no change to inventory. And why not, Jose? They kept the inventory, right? Okay. All right, here we have a purchase. Let's see. So it says a customer purchases. So again, we're still the seller. And here's the journal entry for the sale on credit. Customer returns some printers. Again, it's basically the opposite of the sale, except the debit is to sales, returns, and allowances. Then 5 printers are slightly damaged, so we give them an allowance. Okay, now let's think about this. How much does the customer owe after the return and the allowance? Originally, they owed us $3,500, right? Then, and notice that's a credit to accounts receivable. Wait a minute, sorry. No, my bad. This was the original purchase. Originally, they owed us $19,250. Then when we did the return, we reduced their account receivable by $3,500. Then when we did the allowance, we reduced their account receivable by another $300. So if you take the original amount that they owed, which was a debit to account receivable, and then you subtract any credits to account receivable, you end up with the remaining credit balance or remaining debit balance in accounts receivable, which gets credited off when they make their payment. So I know I didn't say that very clearly, but what it would look like if we were to go to the accounts receivable account, we would see a debit of $19,250, followed by a credit of $3,500, followed by another credit of $300, and then when they paid it off, a credit of $15,450. What would be the balance in that accounts receivable account at that point? Zero, right? The total amount that they owed has been completely reduced and paid off, right? It got reduced by the return, reduced by the allowance, and then paid off. But the customer didn't pay that amount, right? They paid less because they also got the discount. They paid within that discount window. And for that discount, we don't reduce their account receivable, but we do reduce how much they have to pay. Okay? Just the way we do it. Any questions out there? All right. So here we have sales transactions with the perpetual method. Okay? So again, what you would do if you've got a sales transaction and it's perpetual, if it is the original sale and they paid cash, this is what you would do, what you would debit and credit. And notice there are 4 accounts, right? Because with perpetual, when you make a sale, there are 4 accounts involved. If it's a credit transaction, meaning the customer did not pay, there are also going to be 4 accounts. Really, the difference here is cash is being debited here, accounts receivable is being debited with a credit transaction, right? That's the only difference. Then, when the customer pays, if they get the discount, how many accounts are involved in that journal entry? If they got a discount when they paid, there are 3, right? Because we received some cash, but we also have to journalize the discount we gave them and then wipe off their account receivable. If they did not get a discount, then there are only 2 accounts involved, cash and accounts receivable. If there's a return, this is what we have to do. Again, there are 4 accounts involved. If it's an allowance, only 2 accounts because no inventory. Okay? It's a lot to remember, so that's why these charts are super helpful. Any questions on how you would use the chart? Or where you would find it? Where would you find it? Okay, you can go to Files, PowerPoints, and download the Chapter 6 PowerPoint. And where else could you find this chart? In the textbook, exactly. All right, okay, good. We can practice this record the journal entries for the following sales transactions. Let's see, do we have 2 of these? We do. Okay. All right. I'll tell you what, let's go through one together, and then the second one I'll have you work on independently or in groups. Okay. Let's do this first one together. See, I think I can just, yeah, you know what? I'm going to copy this over to Word. I think it'll be easier. There we go. Okay. Sorry about the delay, everybody. Oops, that did not help. There we go. Okay, so let's go through this one together. We have to create these journal entries. All right, so this is perpetual inventory method. And first we have a sale on credit. Okay, so what are we going to debit and what are we going to credit? Anybody? Accounts receivable, yes. We're going to debit accounts receivable for the $2,450. And what would we debit to go along with that? Sales, oops. Sales, 2,450, okay. And what else?
Cost of goods.
Exactly, cost of goods sold. That is how much? 1,000. And what is our other credit? Merchandise inventory. Thank you, Susanna. Ori. Okay, so that journal entry looks something like that, right? Then the customer returns $500 worth of merchandise, which cost us $130. How are we going to journalize that return? What would we debit?
Sales returns and allowances.
Exactly. Thank you, Julian. Sales returns and allowances. That's going to be 500. And what do we credit? Accounts receivable. 500. And what else?
Merchandise inventory.
Okay, merchandise inventory. And what amount is that going to be? 130? Right, because that was the cost of that merchandise for us. And what are we going to credit? Yep, cost of goods sold. Perfect. All right, whoops, too far. Great. And then the last transaction, the customer paid their account in full. Do they get a discount? Yep, right, they had 10 days and they paid on the 14th. So that is definitely within 10 days from the 5th. So they get a 2% discount, right? So let's see, what are we going to debit for this transaction? So there is going to be sales discount, yes, sales discount. And how do we figure out that amount? What's that? We have to start with how much they owe us, right? The account receivable. How much do they owe us at this point?
500.
Well, there was a $500 reduction to their account receivable, right? But the original was $2,450.
1,900.
Exactly, yeah. So take the $2,450 original minus the $500 return. They owe us $1,950, and that is what we multiply by the 2% from the credit terms. And we see they get a discount of $39, right? So that is the sales discount amount. Okay, what else is going to go in this transaction? Cash. And how much cash? Yeah, so it's the same 1950 minus the $39 discount, right? Because 1950 is the remaining account receivable, but they get the discount, so they pay 1911. And then accounts receivable gets a credit of 1950. Now everything should balance. All right. Any questions on how we did that, how we solved those? So now let's go to the next one. So this one, let's see how it's different. Sold $8,600 of merchandise on credit. Okay, you see the terms here. Customer returned, and then after the return, there's an allowance. So that's the difference on this one. And then they paid in full. So that's really the major difference here, is that there's also an allowance in this case. All right. So go ahead and take some time. Oh, is there another one after this one? Oh, that's an exercise. Okay, we did number 10 already, didn't we?
Yes.
Yeah. Okay. So yeah, go ahead and work together, and I'll give you 5 minutes or so to try to work through this and come up with your journal entries. Any questions? Okay. So what I will do for the recording here, because I forgot to start recording again, is I'll show what the right answers were for that little exercise we just did. Not technically an exercise. I don't know what we call it. Practice. Okay. So since there are no questions, we can go back to our chapter here. You all told me we did do exercise 10 already. We did not do problem number 2 though, right? So let's go ahead and do problem number 2. Okay, in this one, we have to fill in account names, kind of like we were just doing. Now, does it say anything about periodic inventory here? I don't see it. So that means we can assume it's perpetual, right? And the first transaction, we made a sale, and it was on credit, right? It tells us it was on credit, and it also gives us the credit terms. So in that case, what will we debit? Accounts receivable, that is correct. And what do we credit? Sales, excellent. All right. And we have another debit and credit. What are those? What do we debit here for the inventory? Cost of goods sold, thank you. And what do we credit? Merchandise inventory, right? That's our classic sales journal entry. Then the customer returns 6 hammers for a full refund, okay? So this is that situation where we reverse everything. we're going to credit accounts receivable. We're going to debit, not sales. What do we call this account? Exactly, sales returns and allowances. And we're going to debit merchandise inventory because we got it back, and credit cost of goods sold because our costs went down. Okay, so there's our return. Any questions so far? All right, then C. We gave them an allowance of $200 and they kept the merchandise. So you might remember that looks exactly like the first part of a return. So I'm just going to copy those two accounts. It's a debit to sales returns and allowances and a credit to accounts receivable. But there was no inventory, so that's it. That's all we have to do for that journal entry. And then the customer makes their payment. So what do you think is the larger debit here, the $4,383? There's a smaller debit and a larger debit.
Cash and so.
Okay, cash is the larger one. The sales discount is the smaller one. And then what is the credit? Accounts receivable. Okay. Because that was the remaining balance. If we look back, originally they owed us $6,240. We reduced that by $1,170. Then we reduced it by $200. Now when they pay it off, we have to take off the remaining $4,870. They got a 10% discount by paying within the discount window, which is $487. And when we subtract that from the account receivable amount, we get the $4,383 cash that they have to pay. Okay, so really nothing different than what we've already done. It's just practicing those journal entries over and over. Anything need clarification here? Okay, then. Let's see what's next. Oh, shipping terms. Okay, great. Something different. Little different. I think, didn't we have an exercise that dealt with shipping terms? FOB destination and FOB shipping point. Didn't that come up? Yeah, okay, I thought so. So we talked about this a little bit. But let's talk about it some more. Okay, so imagine your company has ordered a product from another company and they're shipping it to you. So during that period from when they ship it until it gets to you, it's in transit, right? Some delivery company is bringing it from there to you. So the question arises, who owns that merchandise when it's in transit? And who pays for the shipping costs? And these are important questions. I mean, obviously, who pays is important because you want to try to keep your costs down. If the seller will pay for shipping, great, that saves you some money. But also the question of who owns it. If you own it, it's an asset on your books. If the shipper or the seller still owns it, it's not an asset on your books yet, right? So that's important from an accounting standpoint. There's also the insurance question. If you own it, you better have it insured, because what if it gets lost or stolen while it's in transit? You don't have insurance, you're basically out, whatever that money is. The shipping company that's doing the delivery, they might offer some insurance on it, but not necessarily. So these are important questions. And that's why when a purchase is made, there are shipping terms, just like there would be credit terms to let the buyer know when they have to pay and if they might be able to get a discount. There are shipping terms so that the buyer knows when they will own the property and who has to pay for the shipping costs. I think I've basically said everything here, so let's go to the next page. Okay, so freight is another word for things that are being shipped, cargo, okay? And let's see. Okay, I guess we'll just look at this journal entry. So this company bought some computers and the buyer is paying for the shipping costs. Okay, so if you're the buyer and you're having to pay for the shipping costs, that increases the cost of your inventory. So that shipping cost, notice, is a debit to merchandise inventory. Okay. If you're the seller, it's a different journal entry, but if you're the buyer, that's what it's going to look like. Assuming you're using the perpetual inventory method. All right, so here we have a new term, freight out. That means the seller is responsible for the shipping costs. For the rest of this chapter, we're going to refer to that as FOB destination. So it means the same thing, freight out or FOB destination, both mean that the seller is responsible for the delivery cost. Now this term, FOB destination, I don't think we see it here. Here it is, FOB destination. Does anybody remember what FOB stands for? Freight on board. Freight on board. I don't really know why. Not really sure why we use that term, but that is the term. So FOB destination point means that the seller is responsible for the shipping costs and the seller owns the goods until they reach their destination point. For me, that's the way to remember it. The seller still owns it until it reaches the destination, and so the seller is responsible for shipping costs. Now notice the way the seller would journalize it is as a delivery expense. So if you're the seller and you are responsible for the shipping costs, you would journalize those shipping costs as a delivery expense. Okay, then the other option is FOB shipping point. This is the one where as soon as the product leaves the seller, so at the point where it's being shipped, it becomes the property of the buyer. And the buyer is then responsible for the shipping costs. Think of shipping point as when it leaves the seller. That's the shipping point. So the buyer owns the property and is responsible for the shipping costs. And again, the way they would journalize it as the buyer is merchandise inventory. So if you're the seller, it's delivery expense. If you're the buyer, it's merchandise inventory. Here, you'll find this in the textbook and in the PowerPoint, obviously. If you don't remember which is which, this tells you. With FOB shipping point, the buyer pays the shipping. FOB destination, the seller pays the shipping. Okay. All right. So here we've got a situation where our normal procedure is FOB shipping point. Now, if we're the seller and it's FOB shipping point, we don't have to worry about paying for the delivery costs, right? Because we just saw FOB shipping point, the buyer pays for it. So if we're the seller, great. We don't have to worry about shipping costs. But we have a buyer, a long-term customer who wants us to cover the shipping costs. should we make an exception since they're a long-term customer? What do you think? Maybe, right? Maybe if we value them as a customer and we're afraid that we're going to lose them, if we insist that they pay the shipping costs, yeah, maybe we should. On the other hand, it depends. We might say, sorry, we value your business, but we can't afford to cover the shipping costs.
I wouldn't.
You wouldn't do it?
Is that, because of the airlines,
Other customers, yeah, they talk, right? They talk to each other and they might say, hey, you're giving that guy a discount. Why don't you give me a discount? Or why don't you cover my shipping costs? So there is no right or wrong answer, but here's a question. If we do change the shipping terms, so if we do agree that we will now cover the shipping costs for this customer, what kind of requirements might we put on that arrangement? Sign an NDA? Have them sign a non-disclosure agreement so they're not allowed to tell anybody that they're getting free shipping from us, okay? Yeah, and that could be good. What else? Do we set a minimum that they have to order, or maybe a maximum that we're only going to cover it up to a certain point? Or only if we're shipping within the United States, right? We might specify some sort of restrictions so that it doesn't get out of hand. Okay, great. Well, that's pretty much it for shipping. Okay, so again, if you get confused on those concepts, you can go back to that graphic. A multi-step income statement. I think we did one or two of these, didn't we? In the exercise set? Or I could be mixing this up with my online financial accounting class. Did we do a multi-step income statement together? You don't know that. Did we do one where we had to go do part D and then we came back to do parts A, B, and C? No? Okay. All right. So this might be a new concept for you then. A multi-step income statement is just more detailed than a regular income statement. So we'll see an example. This is a simple income statement. This is what we're used to. In fact, do we have a larger one? Okay, let me zoom in on that a little bit. Okay. So you know what an income statement is. We've got our revenues up top. We've got our expenses, and the difference is our net income, right? So let's look at a multi-step income statements. And let's see how it's different. It's the same basic formula. Revenues minus expenses equals net income. But a little bit different because, for one thing, we broke down sales by gross sales, which doesn't say gross, it just says sales, but we know it's gross, minus discounts, returns, and allowances to get us to net sales. Okay, so notice that the discounts, returns, and allowances are subtotaled over here. That is subtracted from gross sales to get net sales. Yeah. Then we subtract cost of goods sold and we get our gross profit margin. That part we've seen before. Then we take out our operating expenses. Now, operating expenses have two categories. And keep in mind, the operating expenses are all the expenses that are not part of the cost of our product. Okay? So anything related to the product itself is part of cost of goods sold. Everything else is operating expenses, and that includes selling expenses, like advertising and salaries for salespeople, but it also includes these general and administrative expenses, and that would be everything else, executive salaries, office supplies. We see depreciation, we see insurance on there. So now we have a total for the general and administrative expenses. Add that to the total selling expenses. That gives us our total operating expenses. We subtract that from the gross margin to get our income from operations. So basically, it is still revenue minus expenses, right? It's just we've broken the revenue down into different categories. We've broken expenses down into different categories. But then here's where it gets a little bit confusing. There's this other section here, other revenue and expenses. Here, we're mixing some revenues and expenses together. We have some interest revenue and we have some interest expense. Okay, let's think about that. What's that all about? Where would interest revenue come from? What would that be? Interest revenue. From a note receivable. It could be from a note receivable, because with accounts receivable, we don't charge interest, but if we made a loan or we allowed a customer to sign a note in exchange for merchandise, notes have interest. So until that customer has paid off the note, we are earning interest. On the other hand, interest expense would be a loan that we have signed where we need to pay it back and we're being charged interest. Okay, so here we've got interest that we're earning and then interest that we're going to have to pay. Now notice that the interest revenue is positive because that's increasing our profits, and interest expense is negative because that's decreasing our profit. So when you combine those two, because in this case the expense was larger, we end up with a negative number here. If the interest revenue had been larger, then this would be a positive number. So that gets a little tricky. Whether you add it or subtract it depends on you have more other revenue or more other expense. Maya?
When you roll up the credit and the debit side, so in that case, when it's in parentheses, you would add everything except the 90% that color, or?
Well, see, this is a financial statement, so these aren't credits and debits. Yeah, it looks like it, right? But it's not. It's not credits and debits. It's, you know, basically we're just subtotaling this information and then moving it over there. Yeah, but good question. Yeah, if this were credits and debits, we would never have a negative number. But here we do. Okay, and so then since this is a negative number, we're going to have to subtract that from income from operations, and that will give us our net income. So you see it is the same basic format, revenues minus expenses, plus some more revenue minus some more expenses to get to our net income. But it's a little more detailed than the simple income statement. Okay, and we will be going through one or two of these together. Any questions on this one? No? Okay. All right. Oh, here's another new concept. Pretty simple. This is a ratio, the gross profit margin ratio. So if you remember, on both the multi-step income statement and on the, okay, not on the simple income statement. Okay, we don't have it there. Interesting. Okay. Sometimes you do see it on the simple income statement, but not in that case. So remember here we saw gross margin. I think I've said this before, but gross profit margin, gross profit, gross margin are all the same thing. Okay, it's just supposed to confuse you, but don't worry about that. So we take our gross margin, which is our revenue minus our cost of goods sold. So basically that's telling us how much profit have we made just by taking our sales and subtracting the cost of our products before we get into all these other expenses. Okay, so that's what our gross margin is. If we take that number, remember gross margin is sales minus cost of goods sold, right? So if we take that gross margin and we divide it by our net sales, that gives us our gross profit margin ratio. So what that's saying is of our net sales, what percentage of that is our gross profit? So in this case, this is from that example, yeah. So if here, notice cost of goods sold is 293,500, right? No, that's net sales, sorry. Net sale, sorry. Net sales is 293,500. And gross margin is 113,500. Oh, and then cost of goods sold is 180,000. Okay. So if you take your net sales minus your cost of goods sold, which again gives you your gross profit margin, divide it by your net sales, what that's telling you is your gross profit is 39% of your sales. So for every dollar that you bring in sales, 39 cents of that is gross profit. The other 61 cents is going to cover the cost of your products. Now that doesn't mean that you're keeping that 31%, right? Because this is your gross profit margin ratio. This is not your net income. So that is the formula. You could think of it as net sales minus cost of goods sold divided by net sales, or simpler way to think of it is gross profit divided by net sales. Okay. All right, you're an accountant for a small retail store and you're trying to decide, should we use that multi-step income statement or should we use the simple income statement? Let's see those again. Here's the multi-step. Here's the simple. What would be an advantage to using the simple income statement? Less to look at, right? So whoever you're going to be showing this to, the owner, investor, whoever it might be, a bank, it's going to be easy for them to understand what's going on. And it's easier to make it too, right? What would be benefits to the multi-step income statement? Detail. Exactly. Your investor might want more information than what is on the simple income statement. Or any stakeholder might want more information. So this gives them more detail. Exactly. Okay. So which is the best choice for the small retail store? It really depends. If it's going to confuse the owner, probably give them the simple one. You got an owner that asks a whole bunch of questions, probably better to give them the multi-step because it's going to have more answers. Okay, finally, periodic. Any questions on anything here before we move on to the periodic inventory method?
I'm looking at this reports, like if you're using QuickBooks, for
Okay.
example. The computer will do these reports for you, or you also have to do more?
I know, yeah, QuickBooks will make an income statement for you, and I can't tell you for sure, but my guess is you can choose how much detail you want on that income statement. Yeah, I'm not a QuickBooks expert. By the way, if anybody's interested in learning QuickBooks, there is a class here. I forgot exactly what it's called, but it's all about accounting software. So instructor Peter Calvert teaches that. So you can sign up and learn QuickBooks. It might be useful if you're planning to go into accounting as a field or even bookkeeping or have your own business. It'd be a good idea to learn QuickBooks. It's the most common accounting software program for small businesses. Okay, so good question. Any other questions out there? So let's talk about the periodic inventory method. You already know what it is, right? You count up your inventory at the end of the period. Here's an example. This company buys some electronic products. You see these 4 different products, the price for each one. If they, let's see, the whole package, if you add this all together, it comes up to $620 is the price they're going to pay when they purchase it. And so if they were buying 10, it would be 620 times 10. And so they're paying $6,200 for these 10 packages. And now the company that is doing the purchasing, the buyer, notice that they have debited purchases. That is because they're using the periodic inventory method, which instead of merchandise inventory, uses purchases as the account that gets debited when you make a purchase. Okay, then they buy some more inventory. Again, debit to purchases. They haven't paid, so they have an account payable. And then they pay off the account payable later, okay? Then they make another purchase. They buy some tablets. Again, debit to purchases. They haven't paid for it. When they pay for it, they paid within the discount window. Now notice, in this case, it's a credit to purchase discounts. If we were still doing perpetual inventory, it would be a credit to what? Merchandise inventory, right? But because we're now doing periodic, we have to remember, oh, it's a different account. Or if we don't remember, we look at one of those charts and it tells us what we would credit. Okay, then they buy some phones. Again, it's a debit to purchases. They return some of the phones. Now it's a credit to purchase returns and allowances. Again, under perpetual, it would have been merchandise inventory. Under periodic, purchase, returns, and allowances. And they get an allowance, also same account, purchase, returns, and allowances. And they buy some more, okay? I hope they're selling some of this stuff. So far, they just keep buying and buying. Okay, then some of the items are damaged. They return them for a refund. So now let's think about this. They're returning the items for a refund, right? This company that uses the periodic inventory method bought these items, returned some for a refund. Their account payable goes down. They credit purchase returns and allowances. Why is there no inventory listed here? What's that? They don't use that account until the end of the period, right? So with the periodic method, when you make a sale, you don't count the inventory at that time. When you return an item, you don't record the inventory at that time either. All you do when you make a purchase, it's purchases. When you make a return or get an allowance, it's purchase, returns, and allowances. The actual cost of your inventory that you return, you don't have to document because you didn't update your inventory in the first place. Okay. So I guess that's why we have to use purchases instead of merchandise inventory, because we're not updating our inventory. And when we have to figure out our net purchases, we have an account for gross purchases, which is called purchases. We have an account for purchase returns and allowances. We have another account for purchase discounts. And so that allows us to figure out our net purchases. Okay, what's going on here? So they got an allowance. Again, it's a credit to purchase returns and allowances. Their account payable goes down because of the items that they, or because of the allowance that they got. Then they make their payments. Again, in the periodic method, the discount is called purchase discount. You receive a discount called purchase discount. Okay. Again, it's a lot to remember, right? So here we go. If you're doing periodic and you're doing a purchase related transaction, here's your chart. You look it up, either the original purchase, the payment later on, or a return or allowance, and it tells you what to debit, what to credit. Okay. Oh, we can practice. Okay, let's do that. Yeah, let's go ahead and do this one. We can do this one together, I think. Let's see if I can just fit it on the screen here. Okay, let's see if we can just fit this right in here, save us a little time. Okay, all right, we've got 3 transactions. Now this is using the periodic method. First, we made a sale. Oh, we haven't done sales yet for periodic. That's interesting. Okay, well, that's okay. Let's go ahead and do it. So if we make a sale using the periodic method, the first part is exactly the same. It would be a debit to accounts receivable. $2,450. A credit to sales. $2,450. And that's it. Because again, we're not keeping track of the cost of our inventory. Nice and simple. Then a customer does a return. All right. What do you think we're going to debit? The same as it would be for perpetual. Sales, returns, and allowances. 500. What do you think we'll credit? Accounts receivable. 500. And again, no inventory. Then the customer makes their payment. So let's see, they owe us $1,950, right? And they do get a discount because they paid within 10 days. Now this part is the same. It's exactly the same between perpetual and periodic. So it'd be sales discount, cash, and accounts receivable. Again, the entire $1,950 that they owe us gets credited to accounts receivable, but they're getting the 2% discount, right? They're getting that $39 off. Do that. Okay, and then they're paying the difference. So really, the only thing different here with the sale, the return, and the discount, only difference is we're not tracking the inventory. So that's one nice thing. With periodic, the sales are kind of easy because you just leave off the inventory and the rest of it's the same. With purchases, though, as we've seen, that's where it's more complicated. With periodic, we have these new accounts: purchases, purchase returns and allowances, and purchase discounts. So that's what the answers would look like on that one. Anyone have questions? Ready? Oh, yeah. We're already in the PowerPoint. Here we go. Okay, good. We are getting close to the end here. Okay, so let's see some more examples of sales in the periodic method. Here is the computer company again. They are now selling these electronic packages. So we see the sales price and we see the cost, right? Both for the package and the individual units, the individual components of the package, okay? All right, here they make a sale and the customer pays cash. No inventory, nice and easy, right? debit to sales, debit to cash, credit to sales. Nice, easy journal entry. Here they make another sale, the customer didn't pay, debit to accounts receivable, credit to sales. No inventory. Customer makes a full payment, okay? Looks like, well, did they have any, they had no option for a discount. Credit terms were net 15. So when they make their payment, they pay the full account receivable in cash. Okay, pretty simple. Here we have a credit sale. So debit to accounts receivable, credit to sales. The customer does get a discount. Again, notice the account names here are exactly the same as they would be under perpetual. Okay, so sales discounts are no different between the two methods. Here, we make a sale for cash, okay. The customer finds 40 phones of the wrong color and they return them for a refund. We debit sales returns and allowances because it's a return. Because they already paid cash, we have to give them back some cash. But again, there's no inventory because we're using the periodic method. Then we give them an allowance. It's the same. Debit to sales returns and allowances, credit to cash, right? In the periodic system, whether you're doing a return or an allowance, the accounts are the same. Okay, then the company, a customer buys some units from us. They haven't paid us yet. Again, they do a return. We need to get better quality control of our products, I think. We're getting a lot of returns and allowances. So we debit sales returns and allowances, credit accounts receivable. Here we give them an allowance, same thing, right? Same as the return. And then they do get a discount because they paid within the window. Same process that we're used to. And so here's our chart, sales transactions using the periodic method. Okay, we have 4 charts. Perpetual purchases, perpetual sales, periodic purchases, periodic sales. Okay, questions, comments? Right, our summary, good. I think we need a break, right? So merchandisers are resellers, retailers, or merchandisers, right? You can use any of those terms, but in accounting, we say merchandisers. So they take their cash, they buy some inventory, they sell that inventory, collect money from their customers, and now they've got more cash for a new operating cycle, right? So that is their operating cycle. When you make a sale to a customer and they don't pay you, well, you need to establish what are the credit terms. How long does the customer have to pay? Is there any chance they might get a discount, right? And if the company that made the purchase gets a discount, whether it's a return, an allowance, or a discount because they paid early, and they're the buyer, and they're using perpetual inventory, it's a reduction to their merchandise inventory cost, right? That only applies for perpetual. If we give a partial refund, well, okay. If they return the item, it's called a return. If they don't return the item, they get an allowance, right? But either way, it reduces how much they owe or entitles them to some cash back. All right, I mentioned this also, the sales discount is a contra revenue account, right? Because you take your gross sales and you subtract sales discounts. It reduces your net sales. Same thing with sales returns and allowances. Those are also contra revenue accounts. They reduce your net sales. All right, we know the difference between perpetual inventory. You're constantly tracking the cost of your inventory and how much inventory you have, as opposed to periodic, where you do that at the end of the period. We know the formula to calculate cost of goods sold. If you're using the periodic method, you take your beginning inventory, add your net purchases, subtract your ending inventory. I don't see the net purchases formula here, but again, that was your gross purchases minus purchase discounts, returns, and allowances. We also learned about FOB destination versus FOB shipping point. FOB destination, who's responsible for the shipping costs in that case? The seller. And FOB shipping point, the buyer is responsible for the shipping costs, okay? We learned about the multi-step income statement, same basic revenue minus expenses, but just in more detail and with other revenue and other expenses included down at the bottom. And then we also learned the gross profit margin ratio. Anybody remember how you calculate that? Gross profit divided by net sales. Gross profit is the same as net sales minus cost of goods sold. And that tells you what percentage of your net sales is your gross profit. So there we go. I know it's a kind of heavy duty chapter, but we got through it and we're even 10 minutes early. I think we should go ahead and take our break now. We come back in 10 minutes. How's that sound? Okay, so see you at 2:40.